Good morning to all and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. Very good morning to all and welcome to a brand new trading month, which is the 1st of October, Wednesday. So very good morning to all. And before we kickstart today's Wednesday's Daily Dose, which is 1st of October 2025, let's have a quick look at the disclaimer first. 1 second. Right, so hopefully my screen is moving because there's some technical issue at the start. All right, yeah, everything's good. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and it's not investment advice. Past information is not representative of future results. All right, so as usual, before we kickstart today's Daily Dose of Market Insights, let's have a quick recap what has taken shape yesterday in today's early Asia session in terms of relevant economic data, news flow, and their impact on the respective intraday movement of those broad-based cross-asset classes that we cover on a daily basis, ranging from the major US dollar pair, the major stock indices, and as well as the two key commodities market, gold, as well as the West Texas crude oil. So let's kickstart with yesterday's overnight US session first over here. So yesterday overnight US session, there are two key economic data I want to highlight for you guys. Will be the conference board consumer confidence index over here. So we know that in US there are actually two private sector company that compile consumer confidence data in the US. One is the University of Michigan that was done about 2.5 weeks ago, and conference board. Okay, why consumer confidence is very important for the US economy? Because it's a leading US economic indicator, and consumer confidence representing a head start of what will be the potential spending behavior of US consumers, i.e. retail sales. And we know that retail sales constitute services activities in the US, and services activities in the US constitute close to 3/4 of annualized US growth for the past 20 years. So that's why consumer confidence is very important. A slowdown in consumer confidence potentially will see a slowdown in the US economic growth, and that could actually increase the odds of more future Fed funds rate cuts going down the calendar or down going forward in the near future. So yesterday, consumer confidence came in weaker than expected. What market is expecting was 96. So it printed 94.2 for the month of September, and also way below 97.8 that was printed in the previous month of August over here. And this 94.2 is the, let me share with you guys. So hopefully, yeah, you can't see the calendar, you can't see the trend over here. So this is we got to go into the conference board so-called consumer confidence website over here. So at this moment in time, just a while ago, I tried to actually enter it. So it seems to us that there's some technical error over here. Okay, I can't still access it. Okay, but hopefully I can access to the website because it's showing a very clear downtrend, and this downtrend preludes to a previous recession period in the past for the US economy. Okay, unfortunately I can't still show because it's apparent there's some problem with the website, but nevertheless, let me go back again. So this consumer confidence, we call it data as compiled by conference board, is having is deep down to a 5-month low at 94.2. And because of this dipping down to 94.2 to a 5-month low, it increases the risk of a demand slight slowdown in the US economy. That increases bets for this upcoming October Fed funds rate cut in the next FOMC meeting in October. So how do we know that? So if we go to the CME Fed Watch tool, so this CME Fed Watch tool compiles the latest latest odds of whether the Fed will cut, will hold, or will hike, potentially based on the trading behavior of the Fed funds traders inside the Fed funds futures market over here. So Fed funds futures now has increased their rate cut bets potentially by the Fed in the next FOMC meeting on the 29th of October by increasing the odds to 95%. So Fed Funds Futures Trader is assigning a high odds of 95% that the Fed will reduce another 25 basis point on the 29th of October 2025 FOMC meeting to bring down the Fed funds rate lower to 3.75% to 4%. Currently, it's now 4% to 4.25%. So this will be a potential second cut in 2025. Prior to the release of that conference board consumer confidence data, it was at 89.8%. So that's close to around, I would say, around 5 percentage point increase to 95%. And what's interesting over here is that the next cut, the potential third cut for 2025 has also been increased as well by looking at the aggregated debt. So previously, when I shared with you last week, it was previously at a coin flip at around 58%. Prior to the release of yesterday's conference board consumer confidence data, it increased higher to 60%, and right now it jumped much higher to 75%. So right now there's a high chance that the Fed Funds Futures traders is assigning a high odds for a potential third cut of the year for this year in 2025 on the 10th of December 2025 FOMC meeting to further reduce the Fed funds rate to 3.5% to 3.75%. So with this increase in Fed funds rate cut bets being assigned by the Fed funds futures trader, that causes the dollar to weaken further yesterday. So if you look at the trend, the 5-day trend, rolling performance of the US dollar against other major currency as I was speaking right now continues to be in a downtrend. And if you look at the dollar index over here, okay, so the dollar index yesterday closed for the third consecutive session in the red or in losses. So the losses starts to be kickstarted on last Friday. So yesterday is the third consecutive session of a loss, closed down negative 0.14% and continues to trade below the 50-day moving average, which is this dark which is this dark blue line over here, and right now is testing the 20-day moving average. So overall, it seems to be a rather lackluster movement of the US dollar. And if you look at the daily RSI, now it's also trying to inch back down below the 50 level mark over here. So net overall, the dollar now is also facing further downside pressure on top of this weakening US consumer confidence as being shown by the conference board data, which I shared with you guys earlier, and also with this government shutdown that is more or less is impending in about 45 minutes times once the US go into the 12 a.m. mark over here, which is 12 p.m. Singapore time right now. So right now, based on the latest we call it information that we have over here from Bloomberg, the Democrats continues to block this funding bill because the Republicans does not want to adhere to their request to extend their various to extend certain healthcare subsidies over here. So the White House right now commences this shutdown plan over here. All right. So let me share with you guys. Okay. So based on past data and price action behavior in the FX market. So the previous shutdown that has taken shape during October 2013, January 2018, and as well as December 2018 to January 2019, the Bloomberg dollar index remains softer over here. So this is the date. So what it means that starting from the day of the respective 3 past shutdown, as the shutdown progresses over here from 5 days all the way down to 15 days over here, this is the normalized Bloomberg dollar index over here. So starting at 0, anything that is starting at 100 over here, it normalized 100. So we know that in this we call it previous 3 shutdown from October 2013, January 2018, and the last one, which lasted for about 34 days under the first Trump administration, that was in December 2018 to January 2019. That's about 34 days. The US dollar actually plunged, dipped downwards over here. All right. So the one that lasted for 29 days running, from the start of the December 2018 shutdown over here, the dollar index actually lose about 3 percentage point, because it's 97.81. So 100 minus 97.81 is about uh, about 3. It lose about 3% over here, given on the index basis. So net overall, past 3 government shutdown is actually negative for the US dollar. And this time around, things may get much more serious. Why? Because Trump actually threatened to allow the layoffs that comes with the government shutdown to be permanent. All right. So previous shutdown over here is that government got to let go certain non-essential government-related employees, and they will bring them back again once the shutdown has been lifted. All right, but this time round, Trump tried to play hardball. He threatened that permanent, we call it at this point in time, government got to let go certain non-essential government employees, but Trump threatened that this letting go of employers will be permanent. So what it means that there could be much more higher unemployment rate going forward if Trump were to adhere to his threat over here. So that is very likely in line with what Trump wants, because Trump wants the US Federal Reserve to be much more aggressive in cutting rates, and by allowing government shutdown employees layoff to be permanent, that could actually causes the non-farm payroll data to actually be much more lackluster. Unemployment rate potentially may start to rise as well in the next few months. So that could be another catalyst for the Fed to be much more dovish going forward, and to adhere to the US White House request, wanting the Fed to be much more aggressive in cutting rates beyond the current Fed funds level right now, which is only 4%. All right, and also given the fact that if the government starts to shut down today, 1st of October, there could be a risk that government compiled economic data may not get released. And this Friday, we have the non-farm payroll data, which is government compiled data over here. So there's a big risk that the non-farm payroll may not be released this Friday. So market participants will be focusing on privately organization compiled data like the ISM services PMI data to have a gauge of the US economy. All right. And this government shutdown so far is not impacting any risk off in the US stock market. Why? Because previous government shutdown over here, okay, does not really impact on the US stock market as per se. All right. So if you look at the previous government shutdown, right, the worst was 34 days in the last Trump administration in 2018. 1 week prior to the government shutdown, the S&P lose negative 7%. So that was also in line with that tariff threat previously in 2018. But the most importantly over here is that S&P 500 return during the shutdown. Once the shutdown is kickstarted, the S&P 500 rose instead of decline, positive 10%. And 1 week after the shutdown has been lifted, the S&P rose 3.7%. And if you look at all the previous shutdown from 1976 all the way down to 2018, the last one during December, when Trump came into office for the first time, average gain on the S&P after the shutdown is lifted is 0.6%. And prior to the shutdown, it's only lose negative 0.1%. And during the shutdown, after the average of negative and positive is almost unchanged. All right, so market don't the stock market traders don't give a care to the current government shutdown right now. So it's non-essential to them. That's explain why the S&P continues to print higher high yesterday. All right, so yesterday the S&P much higher and closed the dreaded month of September in positive territory. All right, so the SPX gained by 0.41%, the Nasdaq 100 gained by 0.3%, and the Dow Jones and the Russell 2000 also added a modest gain. So the Dow Jones added 0.2% and the Russell 2000 only a minor gain of 0.05%. That's almost an unchanged mark. So if you look at the heat map, the S&P 500 yesterday, it almost attempts to shape a bullish reversal, a continuation from that bullish reversal that is being seen on last Thursday after the test on the rising 20-day moving average. Yesterday, it closed at 6,688, and the current all-time intraday high is at 6,699 on the Tuesday of 23rd of September. And if you look at the monthly chart over here, okay, so this is the monthly chart of the SPX 500. So a very strong bullish Marabuzu candlestick. So far since the month of May, 1, 2, 3, 4, 5. All right, 1, 2, 3, 4, 5. The fifth consecutive session of monthly positive gain in the S&P 500. And yesterday is also the last day of the third quarter. So let me share with you the third quarter performance as well. So third quarter performance is also rather strong, up positive 7.76% over here. And if you look at the latest third quarter performance of the S&P 500, let me share with you the rate of change. Give me a couple of minutes to let it run. Okay, I think it's very slow. I'm not sure why. Okay, ROC, rate of change. Okay, let me reduce this. Let me change this to a 1. Okay, the purpose I'll share with you is that the S&P 500 quarterly return in Q3 this year is one of the best so far. All right. Okay, give me a couple of seconds because it's very slow. I don't know why. Okay, good. Let me put it in. Okay, put it in 1. Okay. Okay, so it's the one of the best quarterly return so far over here, in line with what is being seen in the Q2 of this year as well, which is up by 10.6%, and that is one of the best so far that we see within this year. All right, over here. So given the fact that we are now moving forward from that tariff fear, heading into potential additional liquidity that may come into the US financial market, or the US stock market, with the potential Fed that may get much more dovish if Trump, I mentioned earlier on, get what he wants. That means by potentially shutting down the US government and also potentially allowing temporary layoff in the US and non-essential US employees to get permanent, and that may force the Fed to cut more rates much more drastically, and that could add on more potential liquidity in the US stock market, indirectly creating a positive net impact on the US stock market. So that explains why the US stock market is viewing the government shutdown as a positive trigger for higher highs rather than a negative trigger. All right, over here. And with this, with a US dollar that tends to be weak during past government shutdown, which is having a negative feedback loop of a US dollar right now, a softer US dollar also helped gold to hit fresh all-time high yesterday. So if you look at gold price yesterday, going to much higher, as it's going to shape this bullish acceleration phase. Yesterday, gold added 0.64% and closed at a fresh all-time high of 3,858 yesterday. And in today's Asia session, it continues to post modest gain of 0.13% at 3,863 for spot gold right now as we are speaking. So what are the key interesting levels to look out for spot gold? So yesterday I do highlight one of the important levels to look out for is this shaded green box over here. Previously a minor bullish ascending triangle range configuration, broke out above the ascending range resistance at 3,785. Yesterday, I do want for a potential minor pullback because it hit our first resistance at 3,865. Pullback take shape and look at where the pullback bounced. It bounced exactly at the 3,785 level. So this 3,785 level will be our short-term pivotal support level going forward. Above 3,865, the next resistance level to watch, which is the Fibo extension cluster levels: 3,892, 3,907, followed by 3,938, 3,942, which is also the upper limit of this ongoing minor ascending channel that is in play since the low of 22nd of August 2025 over here. And as long as this 3,785 Titan short-term pivotal support holds, the bullish trend on the minor scale still remains intact for gold XAU/USD. One more news flow update I'll share with you guys will be the weakness on the West Texas oil. So West Texas oil, still recorded previously in my daily dose, I'm still not unconvinced of whatever bounce that we see, because it continues to trade below the 200-day moving average and as well as the minor descending resistance that is still in play from 28th of September 2023 high over here. So right now, it closes below the 20-day moving average on the backdrop of more potential production hikes, not production cuts. That means OPEC Plus is looking to increase oil supply in the month of November, that causing a negative feedback loop into oil prices right now. So right now, I will be using 63.80 over here as my Titan short-term pivotal resistance level, short-term Titan pivotal resistance level. Okay, no longer this level anymore because price action has indeed traded much lower yesterday below the 20-day moving average. Right, so this is a quick update over here, 63.80. So that's West Texas oil. So using 63.80 over here, as my short-term pivotal resistance level. Support level to watch, very important, will be the minor range support of 62.15, 61.85 in first step. And this support level is very important. Previously, it managed to survive. And this minor support has been formed previously during a key risk event as well pertaining to oil price, is during the so-called peace deal talk made up between US President Trump and Russia President Putin then in early September. And a breakdown below 61.85 may expose the previous June 2025 gap up, I think, as the next intermediate support at 61.30. So bear in mind that if this 61.85 support breaks, this could be a very major technical development on West Texas oil. Why? Because if you look at the daily trend of the West Texas oil over here, this level here constitute with this medium-term ascending trend line that I drew from the low of 9th of April 2025. So a breakdown below this 60.55 level over here, which is this region over here as well on the hourly chart. All right, this area here, 60.55 over here. Yeah, this one, this is the one, 60.55, a breakdown below this level here would indicate that the major downtrend phase of oil price continues to decline. All right, over here as it remains kept below this major descending trend line from 28 September 2023 high. So with a lower oil prices, that could reduce inflation expectation going forward in the US, and that could allows the Fed to be more aggressive in rate cuts going forward. All right, so that could also be another push for another catalyst of higher high in the US stock market. All right, so that covers the first segment of today's daily dose. Let me move on to the second segment, which is the chart of the day segment over here. So let me expand my screen so that you guys could share with see what is my chart of the day for today. So today's chart of the day, I will focus on the euro dollar over here. Why euro dollar? Because euro dollar in the last few days managed to stage a bullish breakout from a prior descending trend line this or descending channel resistance that I drew from its previous 4-year high that was made during Expo's FOMC meeting in 2.5 weeks ago. So that was 119.10 previously, and it starts to drift this downwards to shape that minor corrective pullback. So this minor corrective pullback is likely to have ended after that bullish breakout that was seen earlier this week over here, as it tried to actually trade in a very minor sideways range as play around with the 20-day moving average, but managed to close above the 50-day moving average in the last 2 sessions. So with that, I will have a bullish bias for today for the euro dollar, in line with the US government shutdown as well, that in the past tends to see a weaker dollar. So a weaker dollar could potentially benefit the euro dollar going forward, at least in the short term, due to past price action behavior where the dollar is weak in previous government shutdown. So using 116.80 as my short-term pivotal support on the euro dollar, have a bullish bias for today as my chart of the day for the euro dollar, a breakout above 117.60 that is a minor swing high of yesterday, as where it can break for 2 occasions during the European session at 3 p.m. and as well as during the US session at 2 a.m. So this 117.60 will be my potential minor upside trigger level. A breakout above 117.60 will increase the odds of a fresh minor impulsive bullish up move sequence that may unfold on the euro dollar to seek out the next intermediate resistance at 118.20, 118.60, followed by the current 4-year high area at 119.10 that got rejected during Expo's FOMC meeting previously. Only a bearish breakdown below 116.80 will invalidate today's bullish bias on the euro dollar to see it extending its minor corrective decline sequence further towards the downside, exposing the next near-term support zone at 116.30, 116.50, and even 115.80, which is very importantly the minor swing low area of 27th of August and 22nd of August, as well as confluencing with this medium-term ascending trend line that is still in play from the 3rd of February 2025 low. So that's for my euro dollar, and that will be my chart of the day. Right. So before we go, let's have a quick look of the economic calendar. What are the key data to look out for today? So today will be Wednesday. So as we head into the European session thereafter, we have this Eurozone core inflation rate data. That is a preliminary one for the month of September. So market is expecting it at 2.3%, but it may be higher this time around. Why? Because yesterday's we do have Germany preliminary data that came in earlier. So harmonized one is the core inflation rate. So harmonized / core inflation rate in Germany, which is a key country within the Eurozone, the preliminary data for September actually rose higher than expected. So market is expecting 2.2%. Yesterday came in at 2.4% and above 2.1%. That was the previous print of August. So being said that, that could actually potentially see a chance where the core inflation rate for Eurozone, the aggregated one, the flash data for September, to be higher than the previous print of 2.3%. If that materializes, that could add some kind of upside pressure potentially on the euro dollar over here. So as we head into the US session, we have ISM manufacturing PMI data out as well for the month of September. So that is 10 p.m. Singapore time over here. That could potentially influence the major US dollar pair and the major US stock indices, we call it stock prices over here. So that will be 10 p.m. Singapore time for today. All right, then thereafter we'll have a rather quiet US session, and most importantly, we'll see how the impending government shutdown, we call it news flow, that will be in the radar in the next few days. Will there be any potential breakthrough between the Senate's leadership, between the Senate's Democrats and the Senate's Republican? So with that, this is Kelvin here signing off. I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.